you're seeing a lot of GPs going under, taking their LPs with them, and just ghosting everyone. We all talk about passive investing and all that BS, right? Passiveness is a spectrum. It's not binary. If I'm investing 2 times the time in an investment, I want 2 times the return. LPs are still looking to invest. They're just a lot more cautious.
And then there's others where people say, oh, they haven't hit projections, but they're communicating, I'm confident. They just want to know what's going on. Welcome back to the Invest Clearly podcast. I am your host and CEO of Invest Clearly, Pat Zingareld. In today's episode, we sit down with Latan, a tech founder and limited partner who spent the last decade navigating private markets and building Visor, a platform for managing complex portfolios. We talk about risk-reward trade-offs, sponsor underwriting, and why structure of a deal should reflect the experience of the operator. Latan also shares what he's observing across thousands of portfolios that may be contrary to what you think and what he believes needs to change in how GPs handle communication when things go wrong. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. All right, Latan, thank you for joining us. Before we get started, if you want to take a little bit just to talk about your background, tell us a little bit about Visor, what you guys are doing, and then we'll hop into it from there.
Yeah, man, I'm excited. Congrats on the new show.
Yeah, thanks.
I'm happy to be here. Quick background. I'm a tech founder, sold a company, made some money, been investing that money over the past decade, me and my co-founder, predominantly into real estate syndication as an LP, but other types of investments as well. About 5 years ago, had the good problems of managing all these investments and decided to build a platform to manage our own stuff, just to automate, consolidate, and get transparency into what we have and not have to work hard on managing it. And then that evolved into a new company called Visor, which is what we operate today, focused on helping high net worth individuals and family offices track and manage complex portfolios and reducing the back office overload of, admin stuff with a front office type of iPhone experience. Like automating all the back office, you don't have to hire staff. It could be an assistant or a whole team, and giving like a really front end user experience. And we've been doing that for the past couple of years, currently helping a couple thousand clients, a couple tens of billions of assets tracked. And really interesting to see how the industry has been evolving over the past couple of years.
Awesome. Yeah. So you, with all this visibility, all these data points, and talking about how the industry has been evolving, what are you seeing from like the LP decision-making standpoint based on what's going on with GPs?
It's funny. LPs are still looking to invest.
Yeah.
They're just a lot more cautious. It's already common knowledge, right? 3-4 years ago, it was just really easy to find deals. And then zero interest rates were completely, thrown out of the door. And then, it's hard to do deals. And deals that you're in are screwed. And so the LPs got a lot of bad experiences, which is an understatement, with the investments they made. And now they're more cautious on either redeploying capital in the same type of asset classes, same type of GPs, or deploying capital elsewhere, or just sitting on it and waiting. So we're still seeing people deploy capital. It's more larger checks to fewer operators, and public markets, which is interesting, has become more prevalent as it used to be in the past. And so, we did a report where Q1 of this year is like a 70% increase versus Q1 of the previous year into private markets. So new deployed capital has been going to public markets, not private markets.
Yeah, I was going to ask you that if you're seeing, so you do real estate, you do public markets, anything you guys don't do at Visor, and are you seeing trend more than just, into public markets, maybe like shifting from these mainstream assets to some of these niche asset classes? Do you guys follow things like that?
We follow everything. So we're like a real holistic approach to finances. And in the public markets, we don't really go down to the I don't have data on hand like exactly within the public market where people are deploying. in the private markets, which is, more interesting because there's no transparency, and sort
Yeah.
of we have been looking into that more than the publics. And there's all these notions that we've been hearing in the market, but when you open up our data, sort of you see it differently. So, over the past couple of years, there's been a transition from equity to debt investing, people and going into debt funds and stuff like that. And we've actually seen a decrease in that space over the past couple quarters into the private debt landscape, specifically debt funds. Whereas I'd assume that there would be an increase, but actually a decrease. So
Interesting.
that's number one. Number two, in the multifamily space, which also has been hit hard over the past couple of years, because that's most of LPs who touched syndications, their entry level is to multifamily. And so I think it's like 70% of all real estate investments on our platform has been in multifamily. And you've heard about sort of a decrease in multifamily over the past couple of years because people have been affected. But there's actually like a jump back up. So within the private space, which as a whole has been decreased, the private space, but within the private space, there's been an increase in multifamily investments over the past couple of quarters as well, which is also really interesting and surprising for us to
Yeah.
see.
Yeah, that's super interesting. And then with your, I mean, you're in a unique position, especially compared to many LPs that listed in the show. Are you making investments right now, or are you strictly focused on building Visor?
Both. I am
Yeah.
making investments and I'm very focused on building Visor. So yeah, I mean, for us, personally, for me, I'm interested in more, not the multifamily space, just because the returns, I think multifamily is a solid investment. I'm just looking for higher risk, higher returns. And so I look more at other types of stuff.
Yeah. Where are you getting those high risk, high returns from? Like what
Well,
does
I mean,
that, what are those
development
for you?
type deals,
Yep.
hard money lending, uh, triple net industrial stuff, oil and gas. Those have been, people obviously are going to argue if it's higher risk. The way I see it, if there's higher reward, there has to be higher risk, or else, it doesn't really make any sense. I mean, yeah, there's some arbitrage, but when you look at multifamily, which is commercial, but it's very residential at its
Mm-hmm.
core.
Mm-hmm.
And so people are going to need places to live. And so I think that's lower risk than a single tenant net lease of a warehouse.
Yeah. A
So
lot of people have been bringing up industrial. Honestly, a lot of people bring up industrial, but more industrial as one of the safer asset classes right now. But a lot of people on the show have been bringing up oil and gas. Like I've heard a lot of people really focus on that lately. Are you, but mainly on the tax play side of things? What's kind of your approach to that? Is it just in a diversified asset class where, hey, I'm going to put stuff in here, or like what's got you interested in that?
not all oil and gas investments have the tax benefits. And it's really important for people to ask those questions. If you're investing in a fund, you don't always get that appreciation.
Interesting. Okay.
And so it's important to emphasize that. Though for me, it's more, there's two aspects. Number one, we have an energy crisis in the world and in the US particularly, right? We're at a deficit of energy. And I think that people are interested in energy because of that. And then in oil specifically, we're a huge exporter now of oil. And so the US has become one of the largest exporter of oil around the world. And so like that's an opportunity. And also diversification, right, across other asset classes. So maybe that's why it's more interesting. And you get the cash flow is supposed to be extremely high. The IRR is supposed to be extremely high. And so when you compare it to other asset classes like multifamily, which is I'd say 12 to 14% IRR, and 6-7% cash flow, and you look at oil and gas, and it's almost double.
Yeah.
And so that's just appealing more. And then when you look at the alternatives, let's just say go back to debt funds. When you're getting debt funds that have liquidity and 10-11% IRR, and then you compare that to a multifamily deal, which again it's a different risk profile, but it's a bit higher returns. Some people just don't want to take that added risk. Again, everyone sees this
Yeah.
differently. To get 12 to 14, 15% IRR.
Yeah. Well, I'd love to dive more into that like risk profile a little bit more, because you're the first person to have really brought up the high risk, high reward side of things. So like when you're evaluating this, I would say high risk, high reward opportunities, how are you looking at it differently than safer, more traditional opportunities? Are you underwriting sponsors harder or more leniently? Are you underwriting deals more leniently? Or is it just like get to a point, it's an understanding, this is the risk factor and I'm okay with that and move forward? Like what does your DD look like on these sponsors and deals?
So for us, because we're in this unique position, we also have access to the data of the actual performance of people invested with these people, right? So that helps give more clarity and transparency. There's also their own self-reported performance and historic performance, stuff like that. And then there's then there's just a sponsor itself, how big they are, how experienced they are, and it just changes the risk to them, right? If you're investing with a sponsor who's been around for 30 years and their track record is like 90 full cycle deals, like this is a very experienced sponsor. Risk is lower than a sponsor who just started yesterday, right? Yeah. And usually that experience comes also at a premium. That sponsor, because they're so experienced, because it's relatively easier for them to raise capital than the unexperienced sponsor, the terms also match that. That's what I mean by premium, right? So it's a trade-off, right? And that's where risk comes in, and then the reward as well. Fees, waterfall splits, prefs, like all that is different when you're investing with an unexperienced sponsor. Now, sometimes you'll find unexperienced sponsors, maybe they worked somewhere and they have the experience, or maybe whatever it is, but they feel like they have the experience of an experienced sponsor, and they'll have terms similar to that as an experienced sponsor. And that, for me personally, is a red flag, because there's still risk. Like you might be a really good operator at operating a multifamily deal or whatever it is, but you never raised capital from an LP before. There's a whole, complexity derived from that.
Yeah.
That adds risk. Not to mention how lenders see you and how brokers. It's just very different, I think, analyzing that type of stuff. And then that's like the sponsor level. And then there's a deal level risk, which is, if I'm investing in a development deal, there's a different risk profile than I am in a multifamily value add deal, than I am in an oil and gas. All these things have different risk profiles. And the returns need to match that as well. Because if I'm investing in a development deal and the returns are, in the mid-teens, it's just, for me, it's not worth the risk. Same goes, again, like the comparison between a multifamily and a debt deal or stuff like that. So that's the way I see sort of the risk return aspect of it. And I always add another level of, there's risk, there's reward, and there's the time that goes into it. So, because when you compare the alternatives to do with cash, because a lot of people are active real estate people, right? They flip homes, or they do their own deals and they're GPs on their own, and then they compare, wait, hold on, look what they're doing. I can do the same thing. Why would I invest as an LP if I can do this as a GP? And I just think it's always important to take into account the time and effort that goes in on top of the risk reward. Because that's also a spectrum, right? From when it comes to sort of passiveness of a deal.
Yeah.
We all talk about passive investing and all that BS, right? And you come to understand, well, it's not really passive. And I just say passiveness is a spectrum. It's not binary. Because, if I'm flipping homes, that's extremely active, right? There's nothing passive about that. If I'm an owner of long-term rentals and I have a property manager, it's not as active as flipping, but it's also not as passive as being an LP, right? And now the other, so I put, like, in real estate at least, on one side there's flipping homes, which is the most active kind of real estate I think you can do. And then on the far other side of passiveness, which is completely passive, if you want to consider publicly traded REITs as real estate, that's probably the ultimate passive investing in real estate. And so you put these things on the spectrum, and then you add that on top of the risk reward that you're getting into. And for me, if I'm investing 2 times the time in an investment, I want 2 times the return
Mhm.
compared to any other type of investment. And so I always add on the time aspect to the risk reward analysis.
That's super, super interesting. That's super, super interesting. And I really liked um, the terms per experience, like thought process. Most of the people that I've had on the show and I engage with say like it's like track record or bust. It's not like the term should reflect the track record and therefore, you know, give the newer operator more of a shot because it's more favorable. So that's really, really interesting. This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster. One thing I want to talk about that last time I met with you, we were at Best Ever Conference. You were really focused on the SPV strategy. We were talking off show. You said you had stopped doing that. Will you help us understand what an SPV is, I guess the value of it, and then ultimately what made you pivot away from that strategy?
Sure. So as I mentioned, we help thousands of families track and manage their wealth, and that has resulted in tens of billions of assets tracked, which then also results in this huge data set that can bring a ton of value to people. And we've had our clients reaching out over the years and asking us, hey, can you tell us who the good operators, GPs are? Because we see the data. And we've always said, hey, listen, I mean, we don't want to go down that rabbit hole. It's no. And then the end of last year of 2024, we decided, hey, well, why not? And so we did a test where we said, all right, we saw this great operator on our platform. And we said, well, they're raising capital. Let's have them come and pitch a deal. We'll back them with the data that we have. And if it makes sense, we obviously don't want any conflict of interest, so we don't charge anyone for that. And then if it makes sense, we'll put together an SPV so that we can offer our clients a lower minimum and get better terms as we pull capital together to get, it's a win-win-win. It's a good sponsor because we see the data. It's a good deal. And also we get the best terms because we pull capital together. That's why we started to put together these SPV. And that first use case was a success. And so we started to do more of those, bring good operators, pitch deals if it made sense, put together SPVs. People wrote a $50,000 check and they got $5 million terms. And we took a small management fee just for the SPV, just to cover the cost of the SPV itself. And the SPV, just for clarification, for people who don't know, an SPV is a special purpose vehicle. It's basically you create a legal entity, a company, where everyone who invests in the company is basically a partner. And then that company together invests as one check into the bigger one, right? So if a GP is raising capital and the minimum ticket is 100,000, and if you invest 100,000, your profit is whatever 8%. But if you invest $1 million, your preferred return is 10%. Then it makes it makes sense. I'd want to write $1 million check, so we'll raise capital into this SPV, create a minimum that's not even 150,000, so that people can pull capital together to invest together into this opportunity to get the $1 million terms. And so we did that a couple of times. And then we just found that, it was bringing value, but we spent so much effort and time doing it, and it just wasn't worth our while to do that because we're a tech company and we need to focus on our tech and not on that. And although it brings value, we're not at that point where we can, split our mindset and bandwidth to do both. And second, and this is really important and interesting because I think also for GPs, and I have conversations with GPs around this a lot. This environment, capital raising environment, requires GPs to be creative. It's difficult to raise money. So when you put together a deal, a fund, or whatever it is, you need to find a way to make that deal attractive to people who write bigger checks. So when you think about, for example, the wealth management RIA space, who can pull capital together to write a check, a big check, they need to be incentivized to do that for their clients. And the GP wants their clients. And so what GPs, if they want to build their strategy properly, they need to make sure when they set up their structures to split the shares. So to create different share classes where if I'm writing a $100,000 check, I get specific terms. If I write $1 million check, I get better terms. If I write a $5 million check, I get even better terms. And I was really shocked that not all GPs or operators think that way. I've met many GPs. If you write a $50,000 check or a $5 million check, you get the same exact terms. And I think that doesn't make any sense. Unless you're a GP that just gets money thrown at you, you don't care. So,
sure. So do many retail LPs know about this strategy? Like, I've talked to quite a few people that run co-investing clubs, which I'm assuming is a version of an SPV. They're coming in with $5,000 checks. They're all pulling together under one LLC. But why don't more people take this route to get better terms? Is it just like an unknown strategy, or it's not mainstream enough, or like, what do you?
Well, it's just hard. And also you have someone to be the point of contact, and that's work.
Fair enough.
And it's hard. And also there's regulatory compliance that goes into it as well.
Yeah. Okay. That makes sense. That was just a sidebar question. We don't have to go too deep into it, but I'd love to dive a little more into Visor and sort of what you're seeing and the value you provide LPs. So it's the wealth management side of things. What do LPs get certain indicators on trends in certain asset classes besides just how are your finances being benchmarked against others? Like, for example, you talked a lot about the trends out of the trends on multifamily, the trends on debt, some of the other things. Are they being notified on these types of things as a user?
Yeah, they are. They get well, we're not doing it inside the product itself yet. So this is more offline where we create a webinar and walk people through the trends that we're seeing. We do show our clients benchmarks to other people like them in the platform, anonymized aggregated data, so they can see how other people allocate their wealth in each asset class, which platforms, managers, GPs are other people investing in, how much money is invested into each of those. And so there's some levels of like insight that at the moment are pretty high level, but the plan is to go deeper on that. And also sort of on the wealth management side of it, because we are holistic, we've also started working with advisors, wealth managers, who then just offer Visor as a benefit to their clients. So they'll operate on Visor to communicate the aggregate wealth, to create that reporting for their clients as well. And it also helps them give more insights to their clients. Because we've also had AI on top and on the bottom of our platform. So on the bottom of the platform, when I say on the bottom, we have a foundation of artificial intelligence that analyzes data, pulls data from any source, extracts it, creates or updates assets and liabilities on our platform. Extremely robust, probably the most advanced in the market. That's on the bottom of the platform. And then on top of the platform, what I mean is that there's two ways to interact with data. There's the conventional user interface, or UI, UX, that most tech platforms have. So we have that component where you can interact with your data. But there's a whole other component on the top of it where you can just interact with your data like in a ChatGPT style. So we pull in your data and we pull in the market data. And so you can interact with it and ask questions about that, how you are compared to trends in the market and so on and so on. And so there's multiple ways to where we're trying to add value on the trend standpoint, on the data standpoint, on market trends as well. So there's a lot of aspects to it.
Sure. You mentioned earlier in this, so you're advising GPs kind of on how to structure deals creatively to attract larger capital from the institutional guys, and then you also just mentioned working with the wealth managers. Based on some of these trends you're seeing within Visor, are you seeing a difference in decision making between the retail investor and the larger institutional, or how wealth managers are making decisions? What I mean by that is, like, obviously these larger players are much more resourced than the individual person who finally, put together 50 grand or just hit the accreditation status to then, like, what strategies are the larger players deploying that the retail people may not be aware of?
So the larger players obviously have access to larger capital, larger checks, and so also to larger players in the market. And so in terms of like private equity firms.
Yeah.
So most of us retail investors are probably not investing in the Blackstones, the KKRs of the world, the Carlyles, unless we're getting to a feeder that's super expensive because the minimums are low. So a lot of the things these wirehouses tend to have is access to these bigger funds. So you see that. And then you also see the wealth management space trying to find good opportunities for their clients because everyone wants to provide an edge. And so they are going deeper and lower into the value chain to the lower tier operators like the ones we're talking about that are more retail oriented. And then, that's where you and like where you guys are providing value and transparency, like how can they choose the good sponsors, where we hope to also provide value so they can see how other advisors or other clients are investing and so that they can bring the best deals to their clients. There's no doubt that the wealth management industry is trying to find that edge in the private markets. Because it's always a competition of like, how do I create more value to my clients? And so, did that answer your question?
Yeah. I always wonder, right? Is like, what do the big guys know or are doing or are trending towards that the little guys are unaware? Because I mean, there is a gap. I mean, you see it in obviously the fees and the structures. There's preferential with size, but from like a knowledge and a research standpoint, I wasn't sure if there was anything that like these guys are waiting on, these guys are avoiding, these guys are seeing that the retail people aren't, that they could know more about to make their decision making process better. So yeah, no, that was a great answer. All right, I know we're kind of leaning towards the end of the call. We're gonna ask my favorite question that I ask everybody. What part of passive investing do you think needs to die?
Oh man, that's a deep question. It needs to die. I mean, I think what needs to die. I think the notion that everything passive is passive.
That's been brought up a couple times. Yeah, it's a
Really?
popular one. Yeah.
Let me think about something else.
No. Why? Tell me why. We can stick with that one. Why do you feel that way?
Well, just because it's an illusion that people think is everything passive when it's not. It's just like people talk about passive income all the time, but they never talk about what that even means.
Yeah.
So, I mean, this passive is not always passive, but I mean, yeah, I it's a great question. I'm not farther.
Sorry, yeah. It's meant to get people thinking. Well, let me reframe it as like, what do you thoroughly dislike about the industry right now? Like maybe something going on. One answer that we had recently was just like people not really fully being aware of the capital stack, how like common equity could be wiped out and without the asset going to zero. Another person brought up negative leverage. Another person brought up the pref equity deals that aren't actually being transparent, that it's rescue capital. I didn't know if there was anything. I mean, passive not being passive has been a big one.
Let me give you ones that I assume people have talked about this as well, but I also think it's really important. You can have bad things happen in a deal as a GP and still be okay with your investors. It kind of feels like recently you're seeing a lot of GPs going under, taking their LPs with them and just ghosting everyone.
Yeah.
And I think that, at least for me as an LP, when I invest, I know there's risk. It sucks when something happens, but there's always risk. And also, I'm a tech entrepreneur. I have investors. Like things aren't always going amazing. And I have to communicate that properly so they're transparent and they know I'm not going to get, investors not going to get mad at me. They might be disappointed. And I understand that and respect it. Not going to get mad at me. I mean, it's a risk. It happens. That's life. As long as I'm, a straight shooter, I'm not lying. I'm not stealing anyone's money. The same goes for any GP. Shit happens, right? And, interest rates, I made a mistake as a GP, right? I made a mistake. And I think that GPs ghosting LPs, because I see that across the board over the past, year or two, is just wrong. Like, own up to your mistakes, your failure, communicate it properly. People will be disappointed. They might not invest with you again, but at least, your morals aren't hit.
Yeah.
And you're not going to get, you could be sued, but at least you're not lying. And I just hear more and more, and that needs to die. Like,
yeah.
GPs that are just like morally in the wrong place, there needs to be like a measure to know, hey, is there a risk this guy's going to lie to me if the shit hits the fan?
Yeah.
That obviously everyone always says, you're always betting on the horse, and the sponsor is the horse in this case, and you want to make sure that they're going to be legit. They're not going to steal your money. They're not going to lie to you. That's a number one.
Yeah, it's funny that tracks so much to what I'm seeing as well, in where when I talk to LPs and they're like looking at a total loss of capital, I brought this up with somebody else, is like they'll bring that up with me for like 10 seconds on the call, and then they'll talk for 45 minutes about how they're not being communicated to about it. It's a wild concept where obviously nobody's excited about losing money or their investment going to zero, but they really care more about the fact that, like, I don't know what's going on. This could be performing well. This could be terrible. Like, I just wish these guys would answer. And it tracks it. We in our reviews, we track like pre-investment communication against post-investment communication. And like the 5-star to pre-investment to 1-star to post-investment tracks against every negative review. And then there's others where people say like, oh, they haven't hit projections, but they're communicating, I'm confident. You know what I mean? It's they just want to know what's going on. But Latan, thank you so much for joining me on here. If people want to know more about Visor or find you, where should they go?
Yeah, I'm pretty active on social media, so LinkedIn, Facebook, Instagram, Litan Yahav. You can head over to the Visor, is VYZER.co. So it's a bad naming, but hopefully you can find it, VYZER.co, and happy to chat with anyone interested in passive investing.
Awesome, Tan. Thank you so much for coming on.
Thanks for having me, man. Appreciate it.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find this show. Till next time, invest clearly.